Assalamualaikum and good morning everyone. My name is Nurul Azima and I'm from Group 10 who would like to present about ESG reporting. This is members of Group 10 that consists Azima, Abdullah and Hidayah. Next is contents of this video. Our group's member will be present about introduction following with theoretical, guidelines, differences, issue arises, and lastly, conclusion of ESG reporting. I will proceed with the definition of ESG reporting. ESG stands for Environmental, Social, and Governance. ESG reporting is a type of corporate disclosure that details the environmental, social, and governance, promises, efforts, and progress of an organization. Moreover, this ESG reporting aims to inform investors, consumers, NGOs, and in some situations, regulators about an organization's non-financial impacts. As with all disclosures, its purpose is to shed light on a company's ESG activities while improving investors' transparency and inspiring other organizations to do the same thing. Do you know how many types of ESG reporting? So, ESG reporting contains two types. Firstly, within annual report, which means annual and sustainability report in one report. As we can see this example from Aeon report that combine annual and sustainability report in one report. Second type of ESG reporting is standalone report, which means the report is separate between annual report and the sustainability report. As we can see the example from the Fraser and Neff Holdings Berhad report using the standalone report. Next, I will touch about the dimension of corporate sustainability. There are three dimensions, which are environmental, social, and governance. First and foremost, environmental is a conservation of the natural world. The environmental dimension of sustainability concerns the organization's impact on stewards of the planet and use resources across the board. Companies that do not consider this environmental risk may face unforeseen financial risks. The environmental dimension of sustainability concerns the organization's impact on living and non-living natural systems, including land, air, water, and ecosystem. The key stakeholder focusing areas are air and water pollution, biodiversity, waste management, and climate change and carbon emission. Secondly, social is a conservation of people and relationship. The social dimension of sustainability concerns the impacts organization has on the social system within which it operates. A sustainable business should have the support and approval of its employees, stakeholders, and the community it operates in. The key stakeholders focusing area of social are labor standards, customer satisfaction, employees engagement, human rights, and lastly, data protection and privacy. Last but not least is governance, which is a standard for running a company. The organization impacts on the economic condition of its stakeholders and on economic system at local, national, and global levels. The key stakeholders focusing area are audit committee, structure, lobbying, board composition, and executive compensation.
Next, I will talk about the related theories with the sustainability report. The legitimacy theory is one of the theoretical perspectives that can be applied to the understanding of ESG, environmental, social, and governance practice. The legitimacy theory posits that organizations operate within a social context and strive to maintain a positive image and reputation in order to gain and retain the support and acceptance of their stakeholders. In the context of ESG, the legitimacy theory suggests that companies adopt ESG practice not only because they genuinely care about sustainability and social responsibility, but also because they recognize the need to align their actions with societal expectations and norms. The theory suggests that companies engage in ESG practice to manage the perceptions of their stakeholders, such as investors, employees, customers, communities, regulators, and non-governmental organizations (NGOs). Next is the legitimacy theory proposes that companies engage in ESG practice to address the expectation and concerns of their stakeholders, as failure to do so may result in reputational damage, loss of trust, legal and regulatory scrutiny, and ultimately a loss of legitimacy. Last but not least, ESG reporting plays a crucial role in the legitimacy theory. It allows companies to communicate their ESG efforts and demonstrate transparency and accountability to their stakeholders. Second is stakeholder theory. The stakeholder theory of ESG emphasizes that companies should consider and address the interests and concerns of all stakeholders who are affected by or have an impact on the organization. According to the stakeholder theory of ESG, stakeholders can include a wide range of groups such as shareholders, employees, customers, suppliers, local communities, government entities, non-governmental organizations, NGOs, and the environment itself. This theory suggests that companies should take a holistic approach to managing stakeholder relationships and strive to create value for all stakeholders. In the context of ESG, the stakeholder theory suggests that companies should consider the environmental and social impacts of their operation and decision. By proactively addressing the concerns and expectations of stakeholders, companies can build trust, enhance their reputation, and secure the support needed for long-term success. And the last one is signaling theory. The signaling theory of ESG suggests that companies engage in ESG practice and disclose relevant information to send signals to external stakeholders such as investors, customers, and the public. According to signaling theory, companies with strong ESG performance may use their ESG practice and disclosure as a signal to differentiate themselves from competitors and to convey their commitment to sustainability and responsible business practice. Next, the theory proposed that external stakeholders interpret ESG signals as indicators of a company's overall quality, management capabilities, and potential for future financial performance. ESG signals also can take various forms, including ESG reports, sustainability certification, ESG ratings or rankings, membership in sustainability indices, and participation in voluntary initiative or commitments. However, it is important to note that signaling theory does not guarantee that companies engaging in ESG practice are always genuinely committed to sustainability. Some companies may engage in greenwashing or superficial ESG activities solely to create positive perceptions without substantive action. This highlights the importance of discerning genuine efforts from mere signaling. There is two types of guidance for sustainability, which is Global Reporting Initiative (GRI) and Bursa Malaysia. Next, when preparing a sustainability report, there are two common approaches in terms of its relationship with the annual report. Firstly, preparing a separate sustainability report. In this approach, the sustainability report is developed as a standalone document that is published separately from the annual report. It allows for a dedicated focus on sustainability related topics, metrics, and performance. The separate sustainability report typically provides a comprehensive overview of the organization's sustainability initiative, goals, progress, and impacts. It may include specific sections on environmental performance, social initiative, governance practice, stakeholder engagement, and future sustainability goals. This approach demonstrates the organization's commitment to transparency and sustainability reporting. And the second one is including sustainability report within the annual report. In this approach, the sustainability report is integrated as a section or chapters within the annual report itself. This integration showcases the interdependence of financial and non-financial aspects of the organization's performance. It emphasizes the organization's commitment to sustainable business practice and its recognition of the significance of ESG factors in creating long-term value. The sustainability section within the annual report typically covers key sustainability topics, performance highlights, goals and initiatives, demonstrating the integration of sustainability within the organization's overall reporting framework. So now I will explain more about the Global Reporting Initiative (GRI). Yeah, GRI is a widely recognized framework for sustainability reporting. It provides guidelines and indicators for organizations to report on their economic, environmental, and social impacts. GRI's framework helps organizations disclose relevant information, set performance targets, and engage stakeholders effectively. It offers different reporting options, including the comprehensive GRI standards and the GRI sustainability reporting guidelines. GRI promotes transparency, comparability, and accountability in sustainability reporting. There are two basic approaches for using the Global Reporting Initiative GRI standard. One is using GRI as a framework for sustainability reporting. In this approach, an organization adopts the GRI standards as a comprehensive framework to prepare a sustainability report. The organization follows the structure, indicators, and reporting principle provided by GRI to ensure a consistent and standardized approach to reporting on its economic, environmental, and social impact. This approach allows for a comprehensive and holistic view of the organization's sustainability performance. Second, using GRI for specific reporting needs. Alternatively, organizations can choose to use the GRI standards or specific parts of its content to report specific information without preparing a full sustainability report in accordance with the standards. In this approach, organizations may select specific indicators or disclosure requirements from the GRI standards that are most relevant to their business or stakeholder interests. So now I would like to show a timeline of the GRI. As we can see, in 2002, it was a launch of the GRI G2 guidelines. GRI released the second version of the sustainability reporting guidelines known as the G2 version. The G2 guidelines further refined the reporting framework and introduced sector-specific supplement to address industry-specific issues. While in 2006 it was a transition to G3 guidelines, GRI launched the third version of the sustainability reporting guidelines known as the G3 version. The G3 guidelines introduced a more comprehensive approach to sustainability reporting, emphasizing materiality, stakeholder engagement, and the reporting to performance indicators. Next, in 2013, GRI published the G4 reporting guidelines, which provided more detailed instruction and guidance on how to prepare a sustainability report using the G4 framework. While in 2016, GRI released the GRI Sustainability Reporting Standard, representing a transition from the G4 guidelines to a new structure of modular standards. The GRI standards were designed to enhance the clarity, usability, and comparability of sustainability reporting globally. The Global Reporting Initiative (GRI) has two types of standards: the GRI Universal Standards and the GRI Topic-Specific Standard. The GRI Universal Standards consist of the GRI 101, GRI 102, and GRI 103. GRI 101, which is the foundation. This standard outlines the principles and key concepts of sustainability reporting, including materiality, stakeholder engagement, and the reporting process. While GRI 102 is the general disclosure. It provides guidance on disclosing information about an organization profile, strategy, ethics, governance, and management approach. And GRI 10T is the management approach. This standard focuses on reporting an organization's approach to managing its significant impact on sustainability issues, including governance, policies, and practice. So now we move to the topic specific standards. Some of the topic specific standards include GRI 200, GRI 300, and GRI 400. GRI 200, which is the economic standard. This standard focuses on reporting an organization's economic performance, such as financial impacts, economic contribution, and market presence. GRI 300, which is environmental standard. It provides guidance on reporting an organization's environmental performance, including energy consumption, emission, waste management, and biodiversity impacts. And GRI 400, which is social standard. This standard covers reporting on social impacts, including labor practice, human rights, product responsibility, and community engagement. There are two reporting principles, which is principle for defining report content and the principle for defining report quality. For the principle for defining report content, this principle guides organizations in determining the content and scope of their sustainability report to ensure it focuses on the most significant economic, environmental, and social impacts. Key elements of this principle include maturity assessment, which is organizations should conduct a maturity assessment to identify the sustainability issues that are most important to their stakeholders and have the greatest potential impact on the organization's performance reputation. Second is inclusiveness. The reporting process should be inclusive, involving a broad range of stakeholders who are affected by or have an interest in the organization's sustainability performance. This ensures that the report reflects diverse perspectives and captures a comprehensive view of the organization's impact. And the last one is completeness. The report should provide a comprehensive and balanced account of the organization's sustainability performance, covering both positive achievement and areas for improvement. It should disclose relevant information on economic, environmental, and social aspects, addressing the key concerns identified through the maturity assessment. And for the principle number two, which is principle for defining report quality, it set the standard for the quality of information reported, enabling stakeholders to have confidence in the organization's sustainability performance. Key elements of this principle include accuracy. The report should provide information that is reliable, verifiable, and free from material misstatement. It should be based on accurate data, supported by appropriate methodologies and measurements techniques. And the second is balance. The report should present a balanced view of the organization's sustainability performance, taking into account both positive and negative aspects. It should avoid undue bias or selective reporting that may misrepresent the organization's impact or efforts. Number three is comparability. The report should enable stakeholders to compare the organization's performance over time and against relevant benchmarks or industry peers. And the last one is clarity and understandability. The report should be clear, concise, and written in a language that is easily understandable to the intended audience. Technical terms Jargon and complex concepts should be explained to ensure stakeholders can grasp the reported information and its implication. Next is the second guidance for the sustainability report, which is Bursa Malaysia. Bursa Malaysia, the stock exchange in Malaysia, has its own guidance for sustainability reporting called the Bursa Malaysia's Environmental, Social and Governance Framework. It requires listed companies to disclose ESG information in their annual report, providing guidance on reporting principles, maturity assessment, and reporting content. The framework aligns with international best practice and aims to enhance the quality and consistency of ESG reporting by Malaysian companies.
Next, I will explain more about differences between ESG report and financial report. First terms, which is focuses and the purpose of the report. For the ESG report, it provides the information about the company, environmental impact, social practice, and corporate governance structures, and to communicate the company's effects, strategies, and impacts related to sustainability and responsible business to the stakeholders, while the financial report focuses on providing accurate and transparent information about companies' financial performance, positions, and cash flow to stakeholders to help them make a better decision making. Next, in context of content and the metrics, ESG reports may include the content such as greenhouse gas emissions, energy consumptions, water usage, waste management, employee diversity, and such else, which are relating to environmental sustainability and governance. And it covers a broad range of non-financial metrics and indicators that assess company ESG. While in the financial report, it includes financial statements such as balance sheets, income statement, and cash flow statements, which represents the company's financial data in standardized format. The financial reporting focus on financial metrics such as revenue, expense, and profit. In addition, we will look into the regulatory framework. In ESG report, there is no mandatory global standards, but it seems that there is an increase in regulatory developments and voluntary frameworks from other countries, such as the international framework like Global Reporting Initiative, Sustainability Accounting Standards Board, and Sustainability and Responsible Investment, the SRI. While in the financial reporting is typically following the generally accepted accounting principle, which is GAAP, and the international financial reporting standards, which all of the public listed companies should comply to these standards to make sure that they are following the standardized framework. Lastly, we're going to see on the stakeholder impact. ESG report address the concerns and interests of a broader range of stakeholders, including investors, employees, customers, communities, and civil society organizations. While in the financial report, it focuses to serve the interests of investors, creditors, and regulators, which they will use the information to make business decision making, that maybe to give borrowing to the company or such as. Next, I will pass the presentation to my friends.
Next is regarding the issue that had in ESG reporting. Our groups decide to choose an article that named Corporate ESG Reporting Quantity, Quality and Performance, where to now for environmental policy and practice as our issue. The background of this article is carried out in Sweden. The researcher in this article have raised two questions, which are, is ESG reporting increased? And the second question is, if so, has this resulted in improving ESG quality or ESG performance? As we all know that Sweden is the top leader in developing ESG reporting. Therefore, the researcher answering it by 3 dimensions. The first dimension is quality. ESG information continues to lack the value relevance. The researcher found that the information must be high quality and relevant to the topic in order to improve ESG quality and performance. Secondly is quantity, the problem with voluntary and regulated ESG reporting. Yes, there are many ESG reporting increase in the past few years, but the quality of developed ESG reporting is not really satisfying enough. Therefore, the ESG regulative reporting instruments have been issued and implemented to improve the overall performance of ESG reporting. The third dimension is performance, the problem of improvement due to environmental constraints. And the EU directive has suggested to driving more companies to provide more ESG information. Moving on to the result that developed by the researchers in this article, they answer in accordance with the 3 main questions arise. Firstly, has there been an increase in ESG reporting in Sweden? Yes, it is. The history reporting increased throughout the period in the year of 2008 until 2018, but it increasing slowly at the end of the period. Secondly, has there been an improvement in ESG reporting quality in Sweden? Yes, ESG reporting quality is improving in the year of 2008 until 2018. Lastly, is there an improvement in ESG reporting performance in Sweden? Yes, ESG reporting performance is improving and tendency towards a performance plateau from 2015.
We are now at the end of the session, and I would like to conclude that the ESG report focus on 3 main areas, which is environmental impact, social practices, and corporate governance structures. ESG reporting communicates a company effort, strategies, and impacts relating to sustainability and responsible business practice. An ESG report is a complement to the financial report that will help the stakeholder, such as the investor and creditor, to make a better decision making to the company with the complement of the financial report. And that's all from us. I would like to thank you, all of you, for listening to our presentations, and see you guys next time. Assalamualaikum and good evening.